Hi, this is Eric with Bundle, and today we're going to compare shopping for apples and shopping for mortgages and talk about why shopping for mortgages is way more difficult and it actually creates a situation where the market isn't really efficient because in order for a market to be efficient, you need to have a lot of buyers, so that's people buying homes, refinancing their mortgage, a lot of sellers, that's mortgage lenders, but you also need perfect information or close to perfect information for a market to be efficient. So let's talk about an example of going to the market and looking to buy apples. So if you went to the market and you were looking at three different stands, and the first one sold apples and the price of that apple was $2, you would say, okay, I got it. That's easy for me to understand. I know what a dollar is. I know what $2 is. And then you went to the next stand and their price was $1. Awesome, sounds good. Same exact apple, a dollar cheaper. But then you go to the third stand, they actually also sell their apples for a dollar, but it's a much bigger apple. So it's a better apple for the same price. So automatically you would buy that apple. Super simple for a consumer to make that decision. Now let's sort of do a scenario where what would this Apple shopping experience feel like if it was similar to what mortgage shopping is. And so in mortgages, we have all these crazy industry terms, points, lender credits, mortgage insurance, even interest rates can be confusing for a lot of home buyers. So when they hear those terms, it sounds completely unfamiliar to them. So it's almost like walking up at a market and instead of saying that first apple was $2, it's saying that that first apple cost 3 chickens and a fax machine. That's what they think when they actually look at that price. They don't know what to do with an eighth of a point or a credit of this amount and interest rates of that amount. And then they go to the next person, they say, oh, actually our apple is only 2 chickens and an eighth, or 1.5 fax machines. So they have no clue what you're talking about. And added mortgage insurance, and all that crazy stuff. It's very confusing and very hard for consumers to actually comprehend what they should be comparing. So there's a couple ways that we can work as an industry to fix this, and eventually all markets figure out a way to become way more transparent, make it so much easier for consumers to understand what they're actually buying. And we really believe that the mortgage industry is going to shift this way as well. And so number one is we can consolidate all the cost into the interest rate. So instead of having 15 different fees that show up on your disclosure, it's only the interest rate. So there's no upfront fees, there's no mortgage insurance, all that stuff is paid by the lender and rolled into the interest rate. So this makes it at least one number. The other thing that we can do is we can make it to where these mortgages are quoted in dollars. So we like to let home buyers look at the total 5-year cost of their mortgage. So it makes it much more easy for them to understand what they're really getting into. So going back to this Apple example, one mortgage might cost $52,000 versus $49,000, and maybe another Apple with a little bit better quality, maybe better financial advice or a mortgage company that closes the loan way faster is just a little bit more, but you would maybe choose that one because it's better and really close to that other one. So that's a really good example of how you can make the market more transparent and the pricing more transparent. Another thing that's confusing is how the interest rates move. And so when you go and ask a mortgage company what their interest rate is for today, they'll tell you, but then unless you lock that in, that's going to be changing over the next couple weeks. So you might ask the first lender what their interest rate is when mortgage rates are where that yellow star is, and then you might ask the second lender where their mortgage rates are where the white star is there. So it is that's not an apples to apples view. And so if we did something a little bit more basic, and as you quote rates, maybe you show it as a relationship to something that's in the market. So maybe the 10-year treasury or something like that. So as you're shopping, you know, hey, if I go to you on Monday and come back to you on Friday, yes, I understand that the interest rate market moves up and down, but the difference between some base interest rate and what you're quoting is actually what I'm shopping around for. So this makes it a lot easier to compare lenders across different days and come back to that lender and really understand where they stand compared to other lenders. And just a sort of like a technical industry note, then this would allow lenders to actually just hedge the difference between the 10-year treasury, for example, and the 30-year fixed rate mortgage, which introduces a lot less risk or interest rate risk in the market. So just a really quick short video on why this is so confusing for consumers and a couple different ways that we can make it a lot more transparent over the next few years.